Now, for your future, allow me to repeat very fast. So remember, this is alternative investment. And we're looking at valuation of properties, chapter number 3. Valuation of properties, chapter number 3. We have got 3 methods of valuing properties. We have the income-based approach, where we take the future incomes and then we discount them to get property values. We have the cost approach, and then we have the sales comparison approach. So today's class basically is looking at, is for us to look at the cost approach. So cost approach, I've just explained here and said that the cost approach, you basically use this method for those unique properties. Properties in this case that, there are properties in this country that are very, very unique, like some museums, some churches, they are very unique. So if you wanted today to know the value of this property, you can't use sales comparison because you don't have any museum that has which resembles yours, which has been sold in the near past. So in this case here, the only way out is to look at like how much did it cost me. But you see how much it cost me, that is a very old cost. Would want in this case here current costs of those materials. So basically, if it's cost approach, we shall look at if I was to replace this thing today. So we have a replacement cost including builder's profit. The person who is coming to build. Of course, in this case, they would want to charge some markup, some margin there. So you have that one here. And then you less what we are calling curable deterioration cost. For example, like the question we're going to look at now, which is this November 2017, has a roof. A roof in this case here that was really, really worn out. And this person feels that before I even start talking of selling it or even getting its value, I have in this case to replace the roof. So if I'm going to replace, you know that is now a curable item here. It is something I'm able to remedy. I'm able to cure here. So in this case here, you less curable deterioration cost, like now the roof replacements like that. Once I do that, then I'll be able to get a very important element here called replacement cost, net of any curable deterioration cost. Any curable deterioration costs here, there could be many. Now, this figure is the figure that now will be like my cost of this particular building. So once I have the cost of this particular building, then what should I think about? Now the incurable, the depreciations here. So I'll come and less the incurable cost, which are basically depreciation, and this will be based on this figure, net, this figure here. And then of course, if I've got any other cost associated with this particular building, I have to come and less all of them, like now costs associated with the defects. Perhaps I've got rooms which are faulty. This particular premises, I was able to build it in a very good residential area, but now we have the government of Kenya coming and, for example, putting a sewage near my property. When they put a sewage near my property, of course, there is some quite of value which will be lost. So that value lost, then I should be able to come and do what here? Deduct. I should be able to come and deduct all those expenses. And then once I deduct all those expenses, to get the total value of the property, I will come and add market value of the land that this property is now seated on, that this building is seated on, to be able to get now the total value of the property. And we are going straight away to this question, which is November 2017, question number 2. So November 2017, question number what year? November 2017, question number 2. So November 2017, question number 2 is quite a nice question there. So we read, it's question number 2, question number 2C, Upper Hill Tower, question number 2C, We are told the Upper Hill Tower is a 200,000 square foot residential apartment building located in Nairobi, Kenya. The building has an effective age of 10 years. Well, its total economic life is estimated at 40 years. The building has a structural problem that is not feasible to repair. You can't cure that. The building also needs a new roof at a cost of 1 million. This is a cost which I'm able to, a problem that I'm able to remedy. So this is a curable cost. All right. The new roof will increase the value of the building by 1.3 million. The bedrooms in each apartment are too small, thus rents are 400,000 a year, lower than the competing properties. So you can see a defective cost. So I'll be able to subtract these defective costs here. The negative impact on rents is estimated to be shilling 600,000 per year due to traffic congestion, power interruptions, and inadequate water supply, and dump site being located nearby. So you can see loss of income there because of what here, these dump sites and the other bad crazy things there. All right. So due to recent constructions of competing properties, vacancy rates are increased significantly, resulting in an estimated loss in value of 1.2 million. So we have here competing properties coming from these Chinese people who are putting up high-rise, really buildings. So in this case, we estimate to lose some money there. The cost to replace Upper Hill Tower is estimated at 400 per square foot plus builder's profit of shillings 5 million. The market value of the land is estimated at 20 million. The appropriate discount rate is 8%. They want us to estimate the value of Upper Hill Tower using the cost approach, using the cost approach. So using the cost approach, very easy. So what I will do, ladies and gentlemen, here, I'll come pretty fast. If it's cost approach, I must start with the replacement cost. So replacement cost, including the builder's profit, Fortunately, they have given me that figure there. They have told me there, if you look at the last paragraph before required, the cost to replace Upper Hill Tower is estimated to be 400 per square foot plus builder's profit. So in this case here, we have a 400. So this will be 400 per foot. So we must ask ourselves then, these Upper Hill Towers has got how many feet in total? These Upper Hill Towers has got how many feet in total? You can see at the very beginning, the first paragraph, first sentence, the Upper Hill Tower is at 200,000 square foot. So this per square foot. So times 200,000. So this is the cost of replacing. But remember, we have the builder's profit that we need to build into this value. So the builder's profit, they have told us in the very last paragraph before required that the builder's profit is 5 million. The builder's profit is 5 million. So, ladies and gentlemen, are you able to give me this value? The replacement cost, including the builder's profit. So you simply type there. I think typing will be easier. Great, typing will be easier. The final answer, so it will be 400 times 200,000 plus 5 million, which is the builder's profit, So according to Olivia, okay, both of you, you're getting it at 5 million. We can put our figures in millions. Thank you very much. Now, ladies and gentlemen, if there are any curable replacement costs, we also call them replacement costs, curable costs, we shall never subject those ones to depreciation. So do we have anything, you'll be able to see there. Like they'll tell you that there is a roof which has to be replaced. Like in this question here, they are telling us, that first paragraph, last sentence, actually second last sentence, the building also needs a new roof at a cost of 1 million. So then we have in this case here what we are calling a curable. So less a curable cost. So basically this is any stuff that is repairable. Any stuff repairable or replaceable. So like in this case here, new roof. So the new roof in terms of millions, this will be 1. So you subtract, it's only 1. So then this will give us 84. So from there, ladies and gentlemen, what do? We'll simply call this 84. It is a replacement cost, net of what here? Net of curable costs. Then we come and less pretty first, what we call incurable cost. So incurable cost is what here? Is depreciation. Incurable cost. You see, like, ladies and gentlemen, like for example, even in our own lives, even in our own lives. I mean, there are things that you can cure. There are things that you can really make good of yourself. But whether you like it or not, Olivia and Samuel here, you guys will become old. I'm telling you, there is something that people are trying to fight over globally, is to reduce, for example, in this, to work on not being old. So getting old, depreciation, ladies and gentlemen, is not anything that you can cure, trust you me. You'll do your physical fitness, you'll do whatever, go and try to do some body whatever. But at the end of the day, once you hit 70, around there, over 70, whether you like it or not, you must bend. So in this case, your depreciation is not curable. So how do I get this depreciation? Line number one, we are told line number one, Upper Hill Tower is a 200,000 square foot residential apartment building located in Nairobi, Kenya. The building has an effective age of 10 years. Effective age of 10 years, while its total economic life is estimated at 40. So remember, what we shall then do here is to take this net, replacement cost net, therefore that's the figure. You divide this by the total life, which is 40 there, times 10 years. So basically we are getting cumulative depreciation. Because when you take 84 divided by 40, you get depreciation per year. And this building has been with us for 10 years. So 84 divided by 40 times 10 will end up giving me what year? 84 divided by 40 times 10 will end up giving me what figure? 21. 21 million, our figures are in millions, so you simply write 21 there, like that. So leave it like that. From there now, we'll be able to continue now subtracting other costs that are quite permanent, that we may not be able to do anything to them. So for example, look at the bedrooms thing, paragraph 2. The bedrooms in each apartment are too small, thus rents are 400,000 a year, lower than competing what here? Properties here. So in this case here, we have opportunity costs. Because of very small bedrooms. You can't start increasing bedrooms. This is incurable. Because of small bedrooms. So let me ask you a question. If, for example, you have a figure of, say, 400, in this case here, this is per annum, and then n is infinity, and then r, for example, is 10%. When n is infinity and you want to get present value, how do we get present value? Present value of an infinity amount. Are you able to remember the formula of getting present value of an infinity amount? So every year you'll be getting 400, 400, 400, 400 without an end in sight. So in this case here, our present value will be the amount which is 400 divided by R, This is how you get present value of an infinite cash flow. You see, properties, we assume that properties will stay with us indefinitely. They don't have an end in sight. So like in this particular question here, this concept of bedrooms here really, which are small, costing us 400 revenue in terms of opportunity cost, you know that 400 is per year. So then you need to present value this. So it will be 0.4 because our figures are in millions. So 0.4 divided by the cost of capital required return, which they have told us, ladies and gentlemen, before required, the very last sentence there, the appropriate discount rate is 8%. So 8% is the same as 0.08. So is there somebody who can give me this opportunity cost for having small bedrooms? For having very small bedrooms, what do we have here? For having very small bedrooms, you simply type there. Yeah, I will repeat. But first of all, give me this big figure. What is 0.4 divided by 0.08? I will repeat. Thanks for asking that question. Are you able to give me the figure first? 0.4 divided by 0.08? Yeah, 5. So in this case, I'll come and put here 5. So it's a cost on us. So now remember the formula. You guys are Cifa Advanced Level students. I'm so sure you must have gotten this. formula somewhere. Whenever they want us to give them PVFA, how do we get PVFA? To get PVFA, which is present value, interest factor of an annuity, we normally say it's 1 minus 1 plus R raised to negative n. Everything divided by R. Everything divided by R. And then you are told that when n is infinity, when n is infinite, this n is infinite, then this term is killed. And that is why we say that PVFA, when n is infinity, it's normally 1 over R. It's normally 1 over R. 1 over R. 1 over R. When n is infinite. So then if somebody comes and tells you that, hey, I will give you 10 million shillings every year. I'll give you 10 million shillings every year without an end in sight. Then somebody asks you, to ascertain the present value. To ascertain the present value. How will you get that present value? You'll take the amount, that's 10 million, you multiply with 1 over R. 1 over R because of the infinite thing. So it will be 10 million over R. So anytime they give you a figure that is an annual figure, and then they don't give you the number of years. They don't give you the number of years. For you to be able to get present value, you will come, in this case here, take the amount, and then you divide by what? You divide by R. You divide by R. So like in this particular question, our bedrooms, small bedrooms are costing us. We are losing income, and you're losing income of 400,000 per year, yearly, right? Yearly. Remember, as we are looking at just like the income approach, this 400,000, then would have earned it, right? Would have earned this money if our bedrooms were of the right size, but they aren't. So you're losing money, right? And because it is annually, and the n, of course, for the property is n is infinity, then to be able to get the present value there, we shall take the 400,000 in millions at this point 4, we divide it by R. And the cost of capital, the discounting rate, has been given as 0.08, like that. So I want to believe at least some of that makes now some sense. I want to believe that that makes some sense. And again, we shall continue getting these kind of things as we get along. Does it make some sense, Samuel? Okay. Then now we go to the next paragraph there. The negative impact on rents is estimated to be 600,000 per year due to traffic congestion, power interruption, and inadequate water supply and dam site being located. Look at that. That we have rental being affected negatively due to traffic congestion. And the 600,000 is annual. So when it is annual, then it has to be discounted. It has to be discounted using the same approach. So then again, we have here the opportunity cost. We have opportunity cost. We are losing here. We have opportunity cost because of what is traffic. Because of traffic, negative impact on rent. Negative impact on rent. So then this is how much? 0.6. We divide by the same R, 0.08. 0.08. So 0.6 divided by 0.08, that will give us what figure? That will give us what figure? Mm-hmm. 0.6 divided by 0.08. So that will give us 7.5. It's a cost. Then lastly, we have this vacancy loss. Due to recent constructions of competing properties, vacancy rates are increased significantly, resulting in an estimated loss. So we have a vacancy loss. This one we can't discount because it's not an annual thing. It's a total thing. In an estimated loss in value of 1.2. Is that 1.2 per annum? Just 1.2. It's a lump sum figure they're giving us. So we don't have any other thing really. Now what we need to do is to come and add land value. So you add land value. So are you able to see the value of land here in terms of millions? It is 20. That is it. So then come and give us here the property value. Give us here the property value. Property value. So it will be 84 minus 21 minus 5 minus 7.5 minus 1.2, and then you are adding the land value. The land value is what here? The market value of land is 20. Is 20. Now, there is one thing that you can never bring here because these are cost models. You see, like what they're telling us, there is something they're telling us there, that the new roof will increase the value of the building by 1.3. By 1.3. That is not a cost really. Here we are looking at the cost what here? We are looking at the cost model. So any increases in value, we don't consider really. We don't consider. We don't consider. So then what figure are we getting at the end of the day? What is the property value? What is the property value? So I'll be uploading this video on YouTube, and I would expect you guys, once you get it, don't forget to subscribe to my channel. Don't forget to subscribe to my channel. I want to build a very big community of Cifa students, a very big community of Cifa students. I've realized that there is a problem in the market. So I'm being given a figure of 69.3, 69.3. That is the value of the property, 69.3, 69.3, 69.3, 69.3. I hope you are able to confirm as well. Olivia, you also get it, that's 9.3. Yeah, remember how we're getting it? You are taking this 84 minus 21 minus 5 minus 7.5 minus 1.2 plus 20 plus 20 plus 20. Please confirm, Olivia. I'm normally patient. I would want to see whether you are getting that figure as well. Or if there is a problem, let me get to know what the problem is. Or what the question, if you have gotten a question, please feel free to ask questions. Feel free to ask questions. So as I wait for Olivia to confirm, I would want you to try this question at your own time. At your own time, in terms of cost model, cost approach, I would want you to try May 2017, question number 5D. May 2017 is your homework. I would want you to try May 2017, question number 5, dog. May 2017, question number 5, dog. Olivia hasn't yet spoken to me, but we shall overcome. I hope we are in the same wavelength in terms of understanding. All right. Yeah, thank you very much. All right. So and then you have your homework. Please write your homework down there. Then that will be very good. So then straight away, we will go to the next model, which is the last model, called the sales comparison approach. Sales comparison approach.